welcome to Foundation Excellence. Here is Mr. Mweti, one of the accounting teachers on this platform. There will be other teachers who will be representing or presenting their material. Now, in this channel, we are going to help people, should I say learners, to understand the basics and the fundamentals of actually passing specific subjects, more especially your core subjects. I can't say that school is easy, but I can say this with hard work, determination, and a little bit of cunning, you can be able to progress or pass the way that you would like. Now, in this case, ladies and gentlemen, may we begin. Now, side by side here, you have got the question paper and also again the answer book. So let's look at the question paper. This here on my right, um, ladies and gentlemen, is the question paper. You have all your instructions there. I'm not gonna go through all of that. Now, what we need to understand is our concept. So this is paper one. So in paper one, you've got your GAAP principles, you've got your financial statements. So in this case, here are financial statements, statement of comprehensive income, statement of financial position, and analysis and interpretation to the financial statements. Now, what we're going to do now, we're going to have a series of videos. We're going to start with the first one, the first question, complete it, and after completing it, we'll go to the next question. Now, as I go through this, I'm not going to follow the time allocation which is given here, which is 25 minutes, because I will be explaining and trying to engage you on your previous knowledge if you do have any. If you don't, it's okay, you can hit me up and I will be able to assist you. Now, that is that. Now, ladies and gentlemen, I would like us to proceed. Let us proceed. Now, we're going to start with question one. Now, on this side, you have got your question paper, and we'll start with question one. On this question paper, we go to the answer sheet. On the answer book. Sorry about that. Now, let's go to the answer book. Right. Now, in the answer book, ladies and gentlemen, we have got your question or your answer book on question one. There we go. Question one, GAAP principles. Now, let us come back here to our question paper. We are going to explore question one. Now, remember, ladies and gentlemen, there are 6 GAAP principles in your grade 10 curriculum. Now, we'll start by just analyzing them before we start with the question. So this is supposed to be happening in your brain already when you start getting this question. So the first one here in the GAAP principles, usually, not usually, it's always business entity. Now, I'm not going to be writing in the most neatest of ways, but I am going to try to write in a way that maybe you might understand. The first one is business entity, and then the other one, I'll note the ones that are here, and then I'll add the others. So we are going to have going concern, and then the third one is going to be historical cost. Fourth one will be your matching. Oopsie daisy. Okay. Okay. Let me just continue. The next one, or the fourth one, is going to be matching. These are the 4 ones that you see on the side, and then we're left with the final 2. Now, the final 2, ladies and gentlemen, that we have are going to be first, number 5. It's going to be your materiality, and lastly, we are going to have your prudence. If you don't know these things already and you don't know them properly, I would suggest that you try and get accustomed to them properly. Now, you must understand each and every one of the GAAP principles. It's very beneficial for you, especially in accounting. From now onwards, all the way until tertiary, all the way until you go into your profession, GAAP principles are always there, and you must understand them and know them very well. Explain them even in your sleep. Yeah, be that kind of person. Really, I cannot really say that you be a nerd, but you'll be somebody who knows your stuff. All right. Now, ladies and gentlemen, let us start with the first question. 1.1. Now, when you do matching concepts, you don't really look at 1.1 and then read through everything so that you can get the answer of 1.1. No, 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 no. Understand the concepts that are on the numbering side and understand the concepts which are on the alphabet side. So you match 1.1 to column B, column A, column B. You must view it, see both of it, and then the reading. Then you start reading, then you compare. All right, now let's start comparing the two. Now, the first one is business entity. By looking at this information, we're going to start with A. Is business entity A? If not, then we'll check what A is. Now, business entity. A says that land and building are reflected in the balance sheet at the original cost price or at the original price of 350,000 despite their market value of 500,000. Now, the land and building has a market value of 500,000, but it is recorded at 350 in our books. What concept is this? Is this business entity? No. Is it going concern? No. Is it historical cost? Let's think about this. All assets are recorded at the original cost in which they were purchased at the beginning. This is your historical cost. Now, the historical cost concept is used mostly in asset disposal and is used while calculating depreciation on note number 3. So, yes, this is historical cost because all assets are recorded at the original cost in which they were purchased. So, that's what it is. All right. Now, the first one here, A, will go to 1.3. So, we write our answer on A, 1.3. There we go. That's A. And then we go to B. B says, when a debtor settles his account, the discount allowed is recorded at the same time. Now, is this going concern? No. Is this business entity? No. It can be historical cost because already we have done that. So this must be matching. Now, you don't just write backguess. You must understand what that is. Now, matching concept means that transactions are recorded at the time and date and place in which the transaction takes place. Obviously, we won't record the place, but yeah. So when something happens now, it must be recorded now. That information must match the transaction in your books. So when we look at the 15th of August and we see the receipt written 15th of August, we need to go back to the books, mostly your books of first entry. We must see 15th of August, and the transaction that took place on that day must match the information which is the source document. So in this case, this debtor settles the account and we give him discount. So when we record the settlement of the account, we also need to do what? To record the discount that we actually gave the debtor. So this, ladies and gentlemen, is matching concept. So matching concept, ladies and gentlemen, it is 1.4. 1.4 will give us B. Then we go to C. C says trading stock is valued at 20,000 even though it could be sold at 15,000. Now, what do we look? What is the 20,000 in this regard? We could sell it at 15,000, but the value of it is 20,000. What does this mean? This means, ladies and gentlemen, that this trading stock that we have, it's essentially costing 15,000. But if ever we are to make business with it, make an operating activity with it to run our business, the value of our stock will be valued at 20,000. So what is that difference between the two? That is going to be a profit between the two. So in this case, you must always remember the main purpose of opening a business. Why do we open a business? We open a business with the main purpose of making a profit. So why do we run a business? We run it with the expectation of making a business. So the continuation of a business is based on what? On making a profit. Why am I saying this? Because I'm just speaking concept, profit, and there's nothing on the GAAP principles that speaks profit. There is. That is your going concern. because it means that we are concerned with making a business, with making a profit. The the business, the concern of a business, it is to make a profit. Either we're seeing a loss or not. When the business is running, the concern that we have as a business is profit. So the going concern, even in 20 years, is still going to be one thing: profit. So in this case, going concern is part of C. So C is going to be going concern. So 1.2, going concern, it is C. C. And then we go to 1.2 D, which should be business entity. Now, let's see if we don't just deduce it. We need to understand if it's correct. Now, let's go back to D and look at it. It says, stock taken by the owner is recorded as drawings in the financial statement. Now, the owner takes stock for personal use. We say that this is business entity. It is business entity because the business, it is recognized as its own person, separate from the owner. So if the owner takes something from the business, it means that the owner must pay it back. That's why we record that as drawings. So his main way of paying it back is by him losing the value of whatever it is that he has invested in the business, because drawings affect the investment that the owner makes in the business. Now, ladies and gentlemen, we deduce and we explained. 1.1.1 is going to be D, and 1.1.1 D. So we are done with that. All right. So if anybody has a problem, I'm sorry, but for now we are done with that. If you don't understand what's going on here with the GAAP principles, again, you can just simply, contact me, and then yeah, we'll get back to you. Yeah, but we need to make an appointment. I'm a busy person as well. Okay. Right, so let us continue. We have got 1.2. 1.2 is analysis of transactions. So we need to analyze transactions. How do you analyze transactions? You analyze transactions by following the accounting cycle. The first one is transaction takes place, which is what we have this side. And then we issue a source document, which is the first step. Apparently here the source document is not there. After we issue a source document, we record in the books of first entry. Usually your analysis transactions, the one that you'll be having in your books, will have source document, will have books of first entry. After we have the books of first entry, we record in the ledgers. Emphasis on the S because it's more than just one ledger. So in the ledgers, what happens in the ledgers? The thing that happens in the ledger is double entry, and double entry has to do with the accounting concepts. The accounting concepts that we have, the three main accounting concepts, ladies and gentlemen, is asset is equals to owner's equity plus liability. Some would say asset is equals to liability plus owner's equity. Sequence does not matter, but if ever you're doing your balance sheet, you should know that this is the right sequence to follow. When we do your statement of financial position, you will be seeing why I say that there's the sequence to follow. So in the meantime, I just explained that. So when you get this kind of thing or that kind of setup in your examination paper, do yourself a favor, just write a small equal sign here, and then you write a small addition sign here. This will help you to remember that the left hand side must always equal to the right hand side. Simply meaning that if this side is 0, that means this side must be 0. How do you get 0? Let's say, for example, I'm not going to give an example. We are going to find an example right here, not even far away, just now. Okay. All right. So just do yourself a favor. When you get this analysis on the accounting equation, you would put it there, and the accounting equation, as I said, is created by the accounting concepts. Actually, I didn't say that, but I just simply announced it because I had the assumption that some of you or all of you already know what that is. Okay, so we are going to start here by looking at the transactions. Let us look at the transaction. It says here that analyze the following transactions according to the headings provided in the answer book. The business uses a markup of 50% on cost. Very interesting. Very important information. Okay, note this information. Very important. So when you get this information, you're supposed to note it somewhere on your paper. So maybe you'll be writing markup is equals to how much? 50%. Why is this important? Because markup means profit. So you'll have your cost price plus markup is equal to the price in which you're going to sell your product. That's the selling price. So in this case, markup was 60, so it was given. So it's markup on what? On the cost, always on the cost. You see that this is an amount on the cost. So that means it's an amount that needs to be added. It's a percentage that needs to be added on the cost. So when you deal with percentages, the original cost or the original amount that will be taken out from a specific item will always be 100%. So this is 60% on 100%. You get that, right? So that means markup is how much? Is 50%. And then the selling price, that's SP, is going to be 150. Now, whenever we use this, we need to understand, whenever we use this, ladies and gentlemen, we need to understand the calculation of calculating what was given to what we need. This calculation with the learners that I usually teach, I would say that we are given whatever it is that we are given, we need to multiply it by our need over what we have. What we have is what we are given. Now, the reason why we use different terminologies here is because if this side is in rand value, that means this side must use percentages. Vice versa, if this side is in percentages, that means this side must use rand values. Does it make sense? So it's either you're going to get one which has all, or which meets all the requirements in rands and percentages, and one meeting in rands or only percentages. So when you're given variables, you'll be thinking about this kind of calculation. Okay, so in the meantime, oh goodness, just going to get rid of that for now. Just a now thing, I'm just going to get rid of that. I was just explaining that information that we were given, the markup here. And ladies and gentlemen, as I said, this is supposed to be happening already in your brain. It's not even a split second kind of thing. It's supposed to be happening. You're supposed to know this. Right. We are going to start. Should we start? Yes, let us start. All right. So assume that the bank balance is favorable for all the transactions. That means if we assume that the bank balance is favorable for all transactions, means that the bank will always have a debit balance. Now, talking about that, when you do this part, your accounting equation, you must always think of a double entry. So when you do a double entry, you must think of your accounting equation in terms of ledger accounts. So in terms of ledger accounts, your accounting equation is as follows. All your assets, all your liabilities, all your owner's equities. These are your accounting concepts in your ledger. Now, on which side do they increase or decrease? On the left-hand side, this is the debit side. On the right-hand side is the credit side. Now, we need to deduce which one increases on which side and which one decreases on which side. So, for you to actually understand that, remember this little equation that I said you must always write. If you understand this, it's going to be very easy for you to complete the transaction analysis. Okay, now you have got your assets. Look at the assets. Here are the assets. Assets equals to owner's equity plus liability. These are on which side? On the right hand side of the equation, and they are on the right hand side. So everything that happens here should all equal to this side. So the effects that are happening this side are opposite the effects that are happening this side. Meaning that if all assets are going to increase on the debit side and decrease on the credit side, that means all liabilities will increase on the credit side, and all owners' equities will also do what? Do the same thing as liabilities do, because they're on the same side. And then all liabilities on the debit side will decrease, and all owners' equities will also decrease. However, owner's equity, assets, liability, and owner's equity, all of this are in the balance sheet or the statement of financial position. However, on owner's equity, something else changes. It changes when we come to nominal. Nominal. I don't have enough space. Please bear with me. Nominal account sections. Now, in nominal account section, we look at two things. We look at incomes and expenses. Incomes being represented by a positive and then expenses being represented by a negative. Therefore, in owner's equity, we have got drawings and capital, which capital will be an increase plus, and then drawings will be a minus. And also, again, we have got incomes and expenses. Incomes are going to be recorded on the credit side. There's a plus. And then expenses are going to be recorded on the credit side. Why am I explaining this? Because that information you're going to use on the ledgers. So you need to understand, is it going to be recorded on the debit side or on the credit side? So whenever you get this transaction analysis, if ever you're finding it a little bit difficult to work with, please do make sure that you check out or you create this somewhere on your paper. You draw this, and then after that you can be able to work with it. We can't call it much of a cheat code as it is understanding your concepts. It's just to make you remember. Okay, so yeah, so let's take them out, go away, go away, go away. So I'm just going to leave this for argument's sake. Just leave it up there. All right. Then the accounting equation, I'm removing it. And as I explained that you always need to make sure that your accounting equation, you make yourself a favor and write the little equal sign there and then plus here so that you can be able to identify that the right hand side must equal to the left hand side. That the left hand side must be the same as the right hand side. Okay. All right. So I think we are ready. Are we ready? Okay, we are. Now let us start. We come this side on the transactions. We have an example here. It says that bought stationery for cash 2,000. Now they bought stationery. What did they buy? Stationery. Now remember that what happens on the right hand side must always happen on the left hand side. This is the, ladies and gentlemen, this, ladies and gentlemen, it is the accounting double entry principle. Okay, what happens on the left hand side must happen on the right hand side. So what's happening here? Money is going out. Money is going out. So if money goes out, where do we keep our money, ladies and gentlemen? In the bank. So there we have it. Bank. Bank is a asset. Oh goodness. Right. Bank is a asset. Now, if bank is an asset, it decreases on which side? On the credit side. See, credit side. So we wrote bank on the credit side. And then which account is going to be debited? Stationery. Stationery, is it an asset, owner's equity, or liability? It is an owner's equity. What kind of owner's equity? It is an expense because you must always buy stationery. So it's an expense. So expenses must be recorded on the debit side. There we have it. See? So we're good with that, right? We have identified, sorry about that. We have identified the transactions and we recorded them. Now in this case, we say, what is the amount that was recorded? How much is the amount? It's 2,000. So we write 2,000 here, and then asset minus owner's equity minus, right? So it's going to be minus 2,000 is equals to minus 2,000. Do you see that? So it's the same because we don't have liability. Owner's equity offer income. Of an expense. That's what we have here. Owner's equity of an expense. All right, ladies and gentlemen, we go to 1.2.1. Bought equipment on credit for 10,000 from Twane Furnitures. So we bought equipment. Now, if we buy equipment, what are equipments? Equipments are assets. So if we buy equipment, we are increasing the number of assets. So we bought equipment. This equipment that we bought, how much was it? We start by writing the amount here. It's how much? It is 10,000. So we're going to write 10,000. That's the easy part. Going to write the amount. 10,000. Equipment is an asset. It's going to increase. But it says that we bought the equipment. Please note, it says, how did we buy the equipment? On credit. Okay. So if we bought equipment on credit, What does it mean here? It means that we are going to increase our liabilities, and our liabilities in this case is creditors control. Okay, so we're going to write that creditors control. I don't have enough space, so I'm just going to write creditors. Or should I just change my pen, make it a little bit bigger? Yes, I'm changing my pen. Okay, so we're going to have creditors control. Okay, so we have got our assets which are going to increase, and our debt. Owner's equity, no, but our debt is going to also do what? Increase, because it's on the credit side. Do you see that? Let's go to the next one. 1.2.2. 1.2.2 says that a debtor, Mutusi, paid 4,750 via EFT in settlement of his or her account for 5,000. Now they're settling their account. How much did this person pay? They paid 450. 4,750. That's what they paid. Now the debtor is the person who owes us. So he paid us 4,750. Now when somebody pays us, money goes into the bank. So there we go, bank. Now what happens to the amount that's outstanding? In this case, it's 250. What happened to 250? This 250, it is the amount for what? For discount. This is discount allowed. We allowed this person discount. So this is going to be discount allowed. Now this information is from debtors control. Now debtors control, when you go into debtors control account, on the debit side, it must give you the full amount that is being paid off. On the credit side, now the full amount that has been paid off is 5,000. How do we know it's 5,000? Because we say the amount that was paid in settlement and the discount that we gave. You see the discount that we gave here is 250. So we add these two, we get 5,000. All right. So we're good with that. So in the first part of our double entry, when we have got our debtor and our bank is going to be a plus, right? And our debtor is also a asset, so it's going to be a minus. We don't have any owner's equity, we don't have any liability, so the right hand side is equal to the left hand side. Plus 4,750 minus 4,750, that is 0. So 0 is equal to 0, so right hand side is equal to left hand side. And then we go to the second part of our double entry. In this case, we have got your debtors control on the debit side. The credit side is still the same side because they must add up to 5,000. And then we've got the amount which is outstanding from the 5,000, which is 250, which we allowed as discount. Now, that amount that we allowed as discount, ladies and gentlemen, is going to be recorded as such as well. So we are going to have our debtors, which is going to be a minus, and then owner's equity. Now a discount allowed, this is going to affect the business negatively, so it's a form of an expense. So put it under owner's equity as a minus. Then we have it. So right hand side is equal to left hand side. Minus 250 is equal to minus 250. So we've got that. We are done with that. We are settled. We go to 1.2.3. Now in 1.2.3, please note, sold goods for cash. The cost price is 3,000. Remember, when goods are sold, 4 transactions are affected. First of all, we need to record the money coming in. Secondly, we record the stock which we are selling. Does it make sense? So when we record money coming in, already we know bank is going to be affected. And also again, sales. So sales goes hand in hand with what? With bank. So we have got sales to bank. That's the first double entry. And then the first transaction that takes place when sales happen. And then we have got your trading stock to affect your cost of sales. Now, I said to you, ladies and gentlemen, whenever a transaction takes place like this, whereby you are selling stock for cash, four transactions or four books are affected, okay? There should be four entries that are going to take place. Are we clear? So in this case, please note, they already gave you answers here. You can see bank. So bank goes hand in hand with what? With sales. So when you see bank here, you already know that is going to be sales. Now they said that they sold this for how much? They sold this for, they don't tell you, but they say that the cost of it is how much? 3,000. So you have to do calculations. In this case, we're going to do the calculations of the cost price. Remember, as we were starting this video, I showed you that this information of the markup is very important. Now, why is it important? Is because now we're going to use what we're given in order to find what we need. Now, in this case, we are given all the percentages. How many are the percentages? It's going to be 100 for the cost plus 50 for the cost price, for the markup, and then that will give you 150 for your selling price. So this is cost, this is markup, this is selling price. Remember that, right? Now, ladies and gentlemen, let us begin. We are going to say what we're given in rands. We are given the cost in rands or in monetary value. So in this case, we have got 3,000. Let me write this properly, and let me just increase the screen so that if I increase the screen, maybe okay, I don't know why it's not zooming in, but it's fine. Right. So all right, we are going to start with that now. We'll say 3,000. My writing here. Bear with me for a minute. Okay, thank you. All right. Now we are going to say 3,000, which we're given in rands, multiplied by what is it that we need? We need the selling price. Selling price is going to be your cost plus markup. We already know how much is the selling price. It is 150% over. We already know how much is the cost. It is 100. So we need 150 over what we are given, which is what we have, which is 100. And then when you do the calculation, ladies and gentlemen, it's supposed to be there. So in this case, we'll say 3,000 multiplied by 150 divided by 100. So we say what we are given multiplied by what we need in percentages, which is 150, divided by what we have, which is what we are given in rands, to percentages. So that will be over 100. Then the selling price that we're going to be left with, ladies and gentlemen, it is going to be 4,500. This is the answer that you're going to record here on sales, 4,500. It is very crucial for you to write your calculation somewhere, and also again to label your calculation. So in this case, we'll be writing this as sales, and then we have our first calculation for this transaction analysis. Okay, so I think we are done for that. Now in this case, we should come back and just do our transaction and analysis of transaction on the accounting equation. So remember I said that if you see cost of sales, you know that it goes hand in hand with what? With trading stock. So here we come. What are we going to write here? Trading stock. Trading stock. All right, so sales and bank obviously money is coming in, so asset is going to increase. Sales is an income, so it's going to affect our owner's equity as a positive as well. So that's plus plus, and that's a zero there. And then we have got your cost of sales here and your trading stock. So trading stock is an asset because we are selling stock. That means stock is leaving us. And then cost of sales is an expense because it's a negative impact on the sales. So that comes to owner's equity. It's going to have. that negative. That, ladies and gentlemen, is transaction 123. 1.2.3. All right. Now, ladies and gentlemen, let us continue. All right. We are going to go to transaction 1.4. Now, transaction 1.4, ladies and gentlemen, says that the owner took trading stock. The owner took trading stock at the cost of 850 for personal use. So already they gave you the amount there, they wrote it 850, and then they took stock. So we come back here. What did it take? Stock. So stock decreased. Stock is an asset minus. And then this is the person who took the stock, the owner who took the stock. So if it's the owner that takes the stock, this is going to be part of his drawings because it's decreasing the value of his own business. So drawings is part of owner's equity. So therefore owner's equity will be a negative. The left hand side is equal to the right hand side. So we are done with that transaction. We go to the last transaction of 125. Sorry, 1.2.5. 1.2.5. The owner of the business returned damaged goods to the supplier. They were discounted by 5%. The original cost is 1,800. So what exactly is it that we do here? Why did they give us a discount? Let's think about it. They were discounted at how much? At 5%. The original cost was 1,800. So we returned them. So if we return them, that means the discount that we received, which is discount received, it's in the word. You hear that? The discount that we received is going to be affected, right? Now, please note here, we need to return the whole amount. Now, because they put that information there, that means we are going to use this information. Okay? All right. So, ladies and gentlemen, because this was the original cost. On the original cost, it was 1,800, and then we were discounted by how much? 5%. Therefore, how much exactly is it that we owe for the stock? Do we owe them 1,800? No, we owe them less. We need to subtract the discount. So in this case, we must calculate backwards. So we're going to say what we have, which is 1,800. This is the 100% before the discount. So we need to calculate how much is the amount that we paid. We paid 95%, or not paid. We borrowed 95%, which is the amount that we need to return of the 1,800. So this, ladies and gentlemen, should give us 1,700 and something. So let me just check the calculator so that you can see the calculation as well. All right. So we are going to say 1,800 multiplied by 95 over 100. 1,710. This is 1,710. So we come back here, we write 1,710. Okay, and then this amount will be for the creditors control because we are returning goods back. So creditors is going to be affected negatively. And where is creditors affected negatively? On the debit side. So debited account, creditors control. Now, creditors control, it is a liability which is going to be negative. Do we have a owner's equity? No. And our trading stock is also going to be returned. So if it's returned, therefore we are losing out on the trading stock. So it's going to be a negative. Ladies and gentlemen, this is your question 1 done and dusted. I hope you guys enjoy, and tomorrow we'll be doing question 2. Now, before we do question 2, for those of you who would have completed this, it's fine. I'll be more than happy to get feedback from you. Remember that specifically this is not for the channel, this is for my learners. So those learners who have completed this, please send them to me, and you can send copies of your question 1 as well, so that I can have a look at it as we prepare for the coming examination. So this is question 2. We'll start with it tomorrow. We'll be doing it and completing it, so that if ever when I finish with the video, then you'll be done, and then we'll be continuing with this. Hopefully by Saturday we'll be done with paper 1, and we'll start with paper 2. Remember that due to curriculum constraints and district times, the ATP is not fully covered yet, and also again considering your learning abilities, we could not reach or complete in time. So, but doesn't matter, we are still going to do this online and do the best that we can. Without further ado, I would like to conclude and close this. Enjoy yourselves, and yeah, have a good day.